Good evening, welcome, marhaba, hello, and salam alaikum to the people who are joining us from Middle East and around. I welcome you all to our webinar series from PMIUA chapter, and I'm quite glad that you people have been turning out on time. So a good pat of band the back to all of you who is coming out on time, and thank you so much for being the part of our series and our knowledge sharing exercise, which we collectively do in the project management fraternity. I see that people are here joining in, so let's give them a couple of more minutes to come in together. Meanwhile, for the people who have joined us very first time, my name is Anchal, and I am your host, and also the person who is going to host and moderate this webinar for all of us. With our esteemed guest, Mr. Gajendra is with us today, and he's joining us from Mumbai, India. And ultimately, it's our honor to have him over here and to have a topic which is quite meaningful, quite practical, and very close to everybody's life and work balance together because we all do the things ultimately for the purpose of happiness and wealth and health. And he's going to touch the wealth part of it with us together. Of course, ultimately, we have a responsibility to make this webinar as much invigorating, as much engaging as possible together with you guys. And we try our level best to bring the as diversified topics, yet not on particular streamlining purpose of one area of the work, but anything which can be really meaningful to the project professionals and can be treated in the way of how do we treat our projects as our professional work. Also, can we do something more about in the longevity perspective? So I'm seeing the people have joined us. Okay, they are just yet coming in all, but yeah, we have got more than 100 people already with us, and that's phenomenal. I think that is this is one of the webinar after a long time. People are joining us in the large numbers, and of course, we have the particular area which we want to let you know that this webinar which we are going to do today will fetch you two PDUs, and the PDUs will come as a part of your presence over here with the same email address. If you registered this webinar, should be the same one which you have in the PMI particular account, and automatically it get credited based to that particular email address into your PMI account that way. So, what's next? So, I think I'm seeing the people have joining and they have a lot of things and aspiration to know about more than what we do in the projects. How do we manage our finances? But I think the webinar's focus is going to be on a couple of points. Let me summarize those points first for the people who are coming in there. Why the freedom of finance is more important for all of us to achieve a successful work life balance. Very important that we also understand the work life balance is associated with financial freedom. What are the different ways and strategies to achieve this freedom? What are the smart goals about the freedom? And how we all one should try to achieve this freedom by applying what, by doing what, right? And then how have I achieved our own freedom as a person, as an individual? So this is the areas which Mr. Gajen will going to touch. Some housekeeping notes, and the flow of the webinar will be, of course, the webinar will last me about roughly 75 minutes, and I will start with the brief introduction of the chapter, followed by the main presentation from Mr. Gajendra. And after the presentation, we will host an interactive Q&A session where you can post your topic related questions in Q&A panel, not on the chat. Chat is predominantly more for a networking area. So if you want to get answer certain question about the topic, please feel free to put them into the Q&A section of the Zoom there. Feel free to share your reflection, although in the chats, your collective experience and comments enriches the discussions. Please understand that we are here to collaborate, and of course, networking is one of the important pillars we always emphasize with. So you feel free to network if you want to engage this on the channel of the chats. And of course, this particular webinar is getting recorded and will be available online in the YouTube PMI UAE chapter channel subsequently, just like any other webinars which we always do. So that's what our commitment towards this. Let me introduce Mr. Gajendra, and of course, then I will go with the PMI introduction uh, by sharing a couple of slides about the chapter. But let's see what Mr. Gajendra has come out to be. So today we have Mr. Gajendra with us. He's a CFA and a very long-term investor and co-founder of a particular firm, Etica Wealth. He has over 20 years of experience across Indian and global capital markets. and he has been leading them since 2011. As a CFA and MBA from IMI Delhi, Mr. Kothari is also a TEDx speaker and a strong advocate of disciplined and long term investing. Through his widely known One Idiot initiative, he inspires millions to build the wealth through the consistent investing and sound financial habits. He has conducted 500 plus sessions globally and impacting over 50 lakhs of individual and a very respected voice featured in leading publications like Financial Times, Economic Times, and ET Now channels as well. Beyond the finance, he is an avid traveler and sport enthusiast and who believes that the best things in life are not the things. Before we go in with the particular topic, let me share my screen quickly and let you go through our chapter introduction meanwhile, and then we will hand over to Mr. Gajendra to see what he has in his kit to share with us. So I'm sharing my screen quickly, giving you the idea of the chapter, and then quickly we will see our main topic. So the chapter is, of course, is the part of PMI, which is being founded by 1969 in the US, and since then we have been the part of this particular franchisee channel. Of course, as a one of the globally recognized standard and credentials comes from PMI. We all know it. Chapter is specifically being driven by the vision of empower and influence individuals with the innovative project economy principles to turn their ideas into the reality. The mission is to basically disrupt and create the value driven opportunities to all our chapter members and our partners to become agile, innovative, and productive in the platform for the growth of project economy. That's what the mission of our chapter is. And of course, the chapter is 100% run by volunteers, 4,000 plus active members, and among the top five in the EM region. We all depend on you to make this chapter activities as interactive and invigorating as much you can in your possibility. And of course, we seek the project professionals' capabilities and offer the rest of the opportunities. With the board of directors recently being coming out new one in the 2026. Here's the board of directors led by President Amina Abdul Rahim and rest of the board of directors who has been shouldering the duty alongside with her. Some benefits of joining the chapter are especially about networking opportunities, learning and knowledge sharing sessions, workshops, webinars, and events, which we also do in face to face, and virtual webinars like this is a part of it, alongside the career growth aspects, which is being done by the volunteering team as well. We also have the something good for the chapter members to voice out their opportunities and their expertise, their views in the form of member spotlight and the members corner. Please feel free to reach out to newsletter at PMIUAE.org if you want to get it through. Of course, we are present in everywhere in the social media, starting from YouTube channel, which we record this webinars, and the rest of the LinkedIn and Instagram and Facebook. And of course, we have the website of PMIUAE.org in order to get you all the possible information from the marketing team and outreach there. So with that, I'm unsharing my screen and want to give this stage to Mr. Gajendra without any further ado so that he can take us through the journey of financial freedom. Over to you, sir. You have to open
Thank
your
you.
mic.
Yeah, thank you, Mr. Anchal, for your wonderful introduction. And I want to thank Ms. Joyce and PMI Dubai for giving me this opportunity to share my thoughts today on this very amazing project that we are planning to kind of bring into reality, from idea to reality, which is what you mentioned. And I think in your introduction, you said the idea of this fraternity is to learn from each other and grow together. So I hope this next 55 minutes that I kind of share with you, all the members, is going to make some difference in your lives. And so without further ado, I'm just going to share my screen. I hope everybody is able to see the screen.
Yeah, it came up.
Okay, perfect. So today's, since Project Management Institute is all about projects, delivering successful projects, this project is a different one because this project is all about you, okay? And the project is about the art of achieving financial freedom to make sure that we have a very successful work-life balance. As a financial advisor, I meet a lot of investors, a lot of people. 80-90% of them, when I meet them, they are somehow not enjoying their work. Okay. Now, I ask this question. Imagine if you have all the money in the world today, how would you be living your life now? And the answers that I get is very different from what they're living right now, which means somehow money is the biggest problem in making sure what they want to do. They should be able to do it, but because they don't have enough wealth or financial freedom, they are supposed to work in whatever they're doing, and as a result, this disrupts the work-life balance because if you're not happy at your work, certainly you go back home not very satisfied, and it affects your personal life as well. So the idea of this session is to show that how this can be possible, and hopefully towards the end of this session we can convert this idea into reality for all of us as a project. Uh, like of in all my slides, I generally say that an investment in knowledge pays the best interest. So this session, I always believe that the biggest investment that we all can make in our lives is the investment in knowledge, and that is what I think PMI Dubai chapter is all about. When you do these kind of sessions, the idea is to gain as much knowledge as possible that can bring a lot of value in our real life. Uh, we waste yours because we cannot waste ours. A lot of your friends may wanted to join this session today, but because something important has come up and they're not able to attend this, I'm grateful to PMI Dubai for putting this on YouTube. I hope if people have missed this, they might get another opportunity to watch this at a later time. But in real life sessions, when the sessions are live, and if you're not able to attend because you think, oh, it's going to, I need to waste a couple of hours for this, in the process we end up wasting years, right? And this we realize at the later part of our life. I'm sure you would have all read this book, Rich Dad Poor Dad. This is amazing book about two parents, rich dad versus poor dad. How the thinking of rich dad is very different from the poor dad, and this is what, we belong to one of these categories, all of us. And Robert Kiyosaki has said one of the reasons the poor are poor is because they do not invest money or time into the financial education. So this session is all about financial education to make you financially freedom. And he also says money without knowledge is a temporary guest, right? You might have the skills to earn money, but if you don't have the skills to manage it well, money is going to remain a temporary guest in your life. He also further says that most people are trained to make money, not to manage it. And that's where financial chaos begins. Many of us may be very good in our technical jobs, uh, but very few of us are good in managing our money. This is something which is not taught in the schools, colleges. Uh, this is also not taught at workplaces. Also, we all learn it the hard way by trials and errors, and in the process, we end up losing 10, 15 years. I also want to say that investing is simple, but the industry has woven a web of complexity to confuse the investor. This is true worldwide. Investing is supposed to be simple. It's not rocket science. In fact, your projects, the projects that you do are far more complicated, right? But and you will know in this session that what do I mean by saying this? Now, why we are all here? We are all here because of this two sentences. Like we all work hard for money. I think that's the main reason that all of us are motivated so that we can earn money, we can create a lot of wealth for this, and in the process, enjoy our life. And I must tell you, 98% of the people fall into the first category, right? We work from Mondays to Sundays, 6, 7 days a week, 8 to 10 hours, trying to earn money. But there are only 2% of the people who fall into the second category, where money is working hard for them, right? And in this session today, we are going to try and move from the first category to another one. Now, this session, I may not need actually 50 minutes. It's such an easy thing that either you'll understand in 5 minutes, or because we're all human beings, we believe that how can it be so simple, right? There has to be something more to it. And as a result, we ourselves make it complicated. And my experience tells me that 95, 98% of the people, therefore, are not able to understand this for lifetime because we think how this can be so simple, right? So, why most of us are not able to achieve financial freedom, right? Uh, when I talk to a lot of investors, retail people, common man across the world, these are some of the reasons, and I'm sure some of these would apply to you as well. People have very limited knowledge about investment options because this money doesn't come naturally. Investing doesn't come naturally to a lot of us. So as a result, the knowledge about investment option is very vague. We rely on our chartered accountants, relatives, friends, colleagues, uh, and we try and borrow knowledge from each other. Remember, guys, remember, friends, wealth can never be created by borrowed knowledge. You have to invest your time. In fact, what you're doing today is actually investing your time in understanding this, right? People do not seek advice from professional advisors. In India, across the world, uh, people think financial advice, it's free, it's supposed to be free, or it's available easily. Or why do I need, advice from someone else? I think I can manage my money well. People are also not clear about risk and returns. While every one of us want to get highest returns from whatever we do, we're not clear that every investment comes with a certain degree of risk, and we don't really know much about it. A lot of people have developed comfort in things like fixed deposits or government savings because they're guaranteed. Uh, if at all people invest in equities, their expectations from equities is very unrealistic. What we saw post COVID, that markets only go one way up, whether it is US markets or other world markets, Indian markets, and people's real expectations have become unrealistic. Overconfidence is another thing. If last 2 years, 3 years has been good, we become overconfident and we think this pattern is going to repeat. No time. A lot of us actually has this issue. While we are all busy earning money, and our money is actually simply sitting idle in the bank account because we have no time managing that. And last but not the least, phobia of handling financial matters. A lot of us don't want to deal with money, don't want to deal with taxation. It gives us stress, right? We don't want to invest because we have this worry that my capital can go down, and as a result, we don't do anything with the idle money. So, as a result of all of this, we are a nation of savers and not investors. I'm sure some of these points would surely apply to you. Now, who do we blame for all of this, right? I've listed out these common problems, and these are the reasons why 98% of the people in the world continue to work for money, right? They don't come into the second category. Benjamin Graham, who is the guru of Warren Buffett, said the investor's chief problem and even his worst enemy is likely to be himself. But the challenge is we don't accept this because there's an ego issue, right? How can I be problem for myself? And till the time we admit that the enemy is us, we will never change for better, right? And I hope today is a good day for you to identify your blind spots, if you have one, to say that I also need help. Okay. So this I've written in Hindi, but I can explain in English as well. You know, do you want to make quick money or do you want to make lot of money? Okay. Unfortunately, we are living in a world where everything is instant, where people want to get quick results, right? So when Jeff Bezos, owner of Amazon, met Warren Buffett, he asked him, Warren, your investing strategy is so simple. Why doesn't everyone just copy you? And Warren Buffett's investment has been publicly available for the last 50, 60 years. The whole world knows about it. There are 300 plus books written on Warren Buffett, his strategies. Yet there is no second Warren Buffett in the world. And the answer is very simple, which he says, because nobody wants to get rich slow. Everyone is in hurry, right? So another challenge which I find with a lot of young people these days, thanks to Chat GPT and AI and Google, uh, Stephen Hawking says the greatest enemy of knowledge is not ignorance, It is actually the illusion of knowledge. We think we know, right? And that's why we get into trouble. So why we need to save money, right? We spoke about work-life balance, right? Why we are working hard? Because we all have dreams. We have dream to buy a dream house. We all have dream to buy a wonderful house by the beach or wherever in the mountains, providing a good future for children, and living a happy retired life. These are the three biggest goals for most families in the world, right? Uh, and these three goals also cost you the maximum amount of money. So by doing right way of investing, it can actually help you all of these goals, and you don't have to compromise on anything. But these goals have to be smart financial goals. And just like any project that you do, each project has a specific requirement. It has a deadline, and we are going to actually, this is very well connected to the day-to-day projects that you do, right? So the project has to be specific at your workplace. Hence, in your personal life, your goals has to be specific, right? It just can't be financially comfortable. You have to say that, okay, I want to pay off all my travel credit card over the next 12 months, as specific as that line item. The second part of smart is measurable, right? Instead of saying, oh, I want to save for my kids' college funds, you have to say, okay, can I save $10,000 each year for kids' college fund? Now you become measurable. Same thing happens in your day-to-day projects. You have deadlines. You want to measure how much input has gone into it, and how much journey you completed in your project. The third is achievable. Uh, it can't be a wish list item, right? Based on your lifestyle requirement and the income, you can't say, look, I want to buy a private island, right? It has to be achievable. You can say, okay, can I save $5,000 for a week-long vacation in Hawaii next year? This looks quite achievable. The fourth is relevant. Make sure this is relevant to your requirement. Uh, I may want to buy a sports Ferrari car, which may not be relevant to you. So whatever it is in line with your financial requirement, you should plan for it. There are certain goals which are non-negotiable, and there are certain wish lists that can be negotiable, which goes lower in the order. And finally, it has to be time-based. It has to have a deadline. Rather than saying, I want to build an emergency fund, can you say, try and save $500 a month until I have 5,000 in my emergency fund 10 months from now? This is time based. So, like all projects, your financial work life balance also need to be smart. Now, why, as I said, why we all need work life balance? Because if you're not happy at your work, I said you will not, very unlikely that you are not going to be happy in your personal life as well. And vice versa. If you have money problems at home, you will not be able to contribute well to the success of your company or the firm that you're working for. And that is why we need a balance. And financial freedom helps you get this. And let me admit, today I'm having full 100% financial freedom. Though I'm giving this session to you, but because I love this, I enjoy this, it's not a stress for me. A lot of us work beyond hours, and it becomes stressful because somehow we have not achieved financial freedom. So, what does financial freedom mean to you? It can mean different things to different people. Uh, it can mean like more options for you, right? For somebody else, it can mean that you can work at your terms and conditions, right? You can take your own holidays. You can define your own work schedule. So it gives you a lot of options. Now, achieving financial freedom as a project, what all things you need to do? And these are very simple stuff, and it has to be in this order. The first thing is protection. Now, since you are the breadwinner in the family, if something were to, like, we have a house, we have house insurance, we have a car, we have car insurance, all of us have a health insurance. Do we have an insurance for our income? What if tomorrow there is no income coming because we're not there? And hence, the first thing which I tell to anyone is make sure your life is covered. If you are the breadwinner in the family, you should have a term insurance, and that's the only insurance you require. First is term insurance, second is health insurance. If something were to happen to you, do you have an adequate health coverage across the world, right? So, and third is, of course, home and motor insurance. So that's protection. This has to be sorted. This is like your seat belt when you get into the car. Mm, You know, this should come right on top of your priority. The second thing you should be doing is don't have any kind of loans on your head, more particularly the expensive loans like credit cards or any personal loans, which cost you very high amount of interest. Then comes the third item. Do you have an emergency fund? And the emergency fund can be for 12 months of your expenses. If you're in a more safe job where the chance of disruption is not very high, if you're in a very risky job, tech-based job where you can be disrupted, then you should have 24 months of your expenses as emergency fund. Remember, this is like a fire extinguisher in a house. You wish it is never required, but when it is required, it is super helpful. So that's how emergency funds work. And then you plan for your short-term goals, like your vacation planning, or you want to buy an iPhone or some small expenses, some near-term expenses, but which are not small, right? Need planning for that. Once you've done for your savings goal, then comes the growth and the long-term goals. The first long-term goal has to be your retirement planning or your financial freedom goal. All other goals can wait. The first has to be your financial freedom goal when it comes to long range financial planning. The second can be children education, then house purchase, and the fourth is any other goal based planning. Once you've done all of this, then make sure, do you have a will, right? Because there's no point planning all of this if you have not prepared a will. And if you have many members in the family, then they don't know what assets to be distributed within whom. The other thing is keep the family involved in the process. I hope you are watching this along with your spouse, right? Uh, because this is a family's financial plan. It's not individual financial plan. Hire a good advisor if required. None of this is very technical. You can do it on your own, but if you find it challenging or you don't have time for this, make sure in whichever country, place, city you are there, hire a good advisor. It's like going to a good doctor to get your, advice on health. Finally, you don't have to review it every monthly or quarterly basis. You can review it once a year, 2 hours on a Sunday. Just go through your finances and make sure that your goals are on track. Or if there has been any change in your life circumstances, it's reflecting in this financial plan. So now I'll quickly tell how I have been doing this. This is my first thing which I shared, term insurance, my risk cover. This is in Indian rupees, INR. So I have almost like 8 crore kind of a term insurance cover. In dollars, it is approximately close to 900,000 US dollars, less than a million. And I pay a very less amount of premium, which means if something were to happen to me tomorrow, my spouse get this money, in a week's time, and her lifestyle is taken care of. Now, this insurance you need to take till 60, generally, till your work life is there. You don't need till 70 or 80 or 100. And by the way, the premiums that I pay every year doesn't come back to me. Okay, it's gone. It's like your health insurance or your car insurance. If you don't, if it doesn't, uh, I mean, if you are alive till 60, you lose all the premiums, but that's a great thing. At least you're alive. And if you're alive till 60, I'm sure you're going to work hard and make your money work hard so that you don't have to depend on this insurance policy. The second is my health insurance policy. Me and my family, 4 people, we are covered for a very good amount, almost like 50 lakhs in INR across India. This is Indian policy. And we don't have to worry about any health ailment, right? Uh, Everything is taken, all hospital expenses are taken care from this policy, right? So these two are the biggest risks that anybody has. And then this is how our lifespan looks like. A lot of us today may be in the third bracket where red is our income, blue is our expenses, and yellow is our savings, or orange is our savings. When you're 40, 45, 50, you're at the peak of your career. This is where you're having the highest savings. And soon we are going to turn 60, and we wouldn't have income. We wouldn't have savings. All we will have is expenses. And remember, friends, all of us have a finite period to save for our goals. We don't have infinite period. And thanks to the world that we're living in the world of AI and many other disruption, this finite period is also going to shrink, right? Which means all the more it is very important for us to understand how to make our money work harder so that we can have financial freedom, so that we can have a good work-life balance. Now, the biggest lesson that you can take home today is the power of compounding. And there are two people, X and Y. X started at the age of 25. He stopped at 35, investing only for 11 years. And he was putting 5,000 rupees or dollars, whatever you can say, per month. So he ended up putting 6.6 lakhs in 11-year period. He stopped investing at the age of 35. And guess what? At the age of 60, he gets almost 5 crore Indian rupees, which is a lot of money for a lot of people to achieve financial freedom. There was another gentleman, Mr. Y. He thought 25 is not the age to start. Let me enjoy my life. Let me think about retirement much later. So at 40, he said he has not done anything, and now he goes on aggressively investing. He's doing 3 times more than X. So he end up investing 15,000 per month for 21 years compared to 11 years, which is what X did. And he ended up putting around 38 lakhs, which is almost 6 times more than what X invested. And guess what? He gets less than half of what X got. Isn't this very surprising that X has been investing only for 11 years? Why putting 10 more years? Why putting 3x more money and yet getting less than half of what X got? So my first question to you is, what is working for X that is not working for Y? And the answer is time. Time is working for X, which is not working for Y. And we all know once time is gone, it is gone forever. And the cost of delay can be really devastating. So let me give you an example. And I'm sure after seeing this slide, you'll be kind of regretting that, oh, I missed all this in my life too. So suppose you're 25, I'm asking you to put $100,000 per annum or whatever amount, or 1 lakh. And if you can do till 60, imagining you earning 12% return, you end up making 4 crore 81 lakh, right? Which is a lot of money in India to retire just by putting 1 lakh per annum for next 35 years. Now, what if you delay this exercise by 1 year? You didn't start at 25, you just started 1 year late. You can come back and tell me that I didn't invest 1 lakh, big deal. So the thing that I want to share is your loss is not 1 lakh or $100,000. Now loss is 52 lakhs or almost $5 million that you've lost because you started 1 year late. You'll now be getting 11% less corpus because you started 1 year late, just 1 year delay. What if you delay this by 3 years? You didn't lose $300,000. You've actually lost $14 million or INR, whatever you can say. You've lost 29% because you delayed by 3 years, right? And what if you delayed by 6 years, just 6 years? You have lost 50% of what you were supposed to make, right? And this is what happens with all our projects also. If we don't start on time, if we drag it, if we delay it, we have to work pretty much harder. Same thing with money also. So the only formula that you have to understand today to create wealth is this formula. I'm sure many of you understand this, have seen this formula before also. This is nothing but power of compounding. We all have studied this formula in standard 7th, 8th in mathematics. Three components to this formula: principal, how much amount you put on a monthly basis or lump sum. R is the return that you earn on your investment. And time is for what period you put this money for. Unfortunately, world over, we don't really talk much about P or time. The only thing which most of us focuses on is R, how much our investments can create returns. Now, this is a classic example. This is how each one of us can build wealth. This is something where if you're putting 50,000 INR every month, and if your money is growing at 12%, right? Now, for 12% returns, you have to invest in something little aggressive. It can't come in safe or guaranteed way. But more importantly, what I want to share with you is that if you want to create 10 crores, over a 26-year period, which is good enough money for people who want to retire at 50. So if you start at 24, in 26 years, you can actually achieve 10 crores. The point that I want to share here is the first 1 crore is the most difficult, the first part of the journey. It will take almost 10 years for you to reach the first milestone of 1 crore. And that is why 99% of the people stop their journey even less than achieving 1 crore before 10 years. The interesting part is from 1 to 2 crore, it takes only 4 years. From 2 to 3 crore, it takes only 3 years. And the best part is the last 1 crore takes only 10 months. Isn't this very ironical that the first 1 crore takes 10 years and the last 1 crore in this journey from 9 to 10 crore takes only 10 months, right? Each one of us has to go through this phase. There's no shortcut that can be applied to this. Warren Buffett went, I went, each one of us had to go through. So the sooner you start, the sooner you will be able to see the results. So Albert Einstein said compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Very few people, unfortunately, understand the power of this formula. My first point was start early. My next point is be regular. Keep on adding on a monthly basis, on a regular basis. Every little bit adds up, right? And where do we really put our money? We can start early, we can put regularly, but where we should put money? Of course, globally, these are the five asset classes. I'm sure you're aware of all these five asset classes. Worldwide, property is the most common asset class which people can relate because it's tangible. Even gold is again most tangible. There's a long track record. Debt means fixed deposits, guaranteed return investment. That's also very popular. The least popular of all these asset classes is equity because this is the most misunderstood asset class in the world. It is the most aggressive out of all the asset classes. It's more volatile, right? Now, how much you should have each of them in your portfolio, which means what should be your asset allocation, right? Then, what determines your asset allocation is four things. What is my goal? And what returns do I need to achieve that goal? So if the goal is financial freedom in 15 years time, I can actually go aggressive. The required return is around 12%. So if you know that my return requirement is 12%, that's the first thing. Second is you can check for your risk appetite. If you're an aggressive investor, you can say, okay, I don't mind volatility in the short term. If in the long term I can earn 12% return, I don't mind seeing a dip in my capital in the near term. Your risk preference is high. Need for liquidity is only after 10, 12 years. And there's no immediate need for liquidity in this goal, and the time frame is 12 years. So this determines your asset allocation, and hence you can be more in equities. But if the same thing was to come in 2 years or 3 years, it has to be in safe investments. Now, this is a very important chart. This is the annualized returns of all asset classes. Since I come from India, the majority of Indians invest in the home markets, which is Indian equities. That has given around 10% to 12% return over the last 10, 15, 20 years. I don't want to talk like 1 year or 3 year because this is short term. US equities, of course, has given the best results in the last 1, 3, 5, 10, 15, 20 years. It has been a very good story. Gold has also given amazing returns thanks to the stellar performance of gold in the last 1 year. The 3 year, 5 year, 10 year looks. Real estate in Dubai, in Middle East, has done pretty well. Real estate is very region specific, and fixed income is like bonds or fixed deposits, which is very safe kind of thing. So these are the five asset classes, and the returns keep on changing between them. These are the returns of Nasdaq, which has done even better than the broader markets in US. And MSCI World, which is more like developed markets, has done better than emerging markets. Always make sure that you know this in background to give you context what kind of returns you might expect in the future. Okay. Now this is Indian equities in the last 80 times in the 80 in 35 years. In INR terms, you have created 80 times wealth, which is 13%, which is not bad because this return is uh, almost 3 to 4% higher than fixed deposits in India. Okay. While everybody when they see this chart, they think it is like a green line, only going up. Actually, it is the blue line, which means a lot of ups and downs. It is not linear. You don't earn 13% returns year after year. There are a lot of years where you earn negative returns also. But of course, the trend line is up. In the long term, yes, you create wealth, but not every year. This is something that you have to understand. And what I mean by this is every year, because markets are volatile, your returns can go down by 10%, 15%. So just to give you a context, in 2026, markets from their all-time high went down by 16%, which means if you put in your money at all-time high, you've lost 16% when the markets went down in March, right? Of course, this is notional unless you have pulled out money. But the good thing is, even though markets go down every year from their all-time high, in last 80% of the time, every calendar year, markets have ended positive, which means only very few instances markets have given return. So right now you are seeing in the second chart, below chart, only in 2026, and we're just 3 months old. That's why we can't count. The last time in a calendar year markets gave negative returns was 2015. So almost 10 years, markets have never given a negative calendar year returns, right? Which is also scary, which means anytime soon, this red line has to come back, right? That's how market works. So what is my mantra to create wealth or to achieve successful work-life balance by having financial freedom? If you want to create a lot of wealth, equities is one of the most predominant asset class in the world, right? To me, generally gold is for ornaments. If I actually exclude last 2 3 years returns, gold in worldwide dollar terms has given 6 7% kind of returns, not as high as equities, right? Insurance is for protection. I would like to have term insurance and health insurance. If I want a guaranteed income, I don't want loss of capital. If I want capital preservation, I would go for bonds or treasury bills. And to me, real estate is for a home and office. Generally, I don't want to invest my money unless I'm getting at a very attractive, cheap price. Then it might be a different thing. But otherwise, if real estate is generally for me as a home consumption item. Simple rules. I follow this. I've been following this for last 22 years of my life. It makes my life much easier. Now, a lot of us people invest in direct stocks. If you want to make money or create wealth using direct equities, like people want to buy Nvidia or whatever, like stocks, Tesla. If you have all three, you can do on your own. Interest, time, knowledge. If you have missing, if you have one of these components missing, please go to a professional. Go for a managed vehicle. You can't. It's very difficult to create wealth, sustainable wealth, by half-baked knowledge. Okay. And when you invest through mutual funds, and mutual funds is available worldwide, your money goes into 50, 100 diversified portfolio, whether it is index funds or ETFs, it's a very diversified portfolio. And all these companies are very, very safe. Unfortunately, again, this is a tweet which I saw, which is, and you can actually remove Indian by anybody else. A typical person is confident to invest in a single property, but afraid to invest in a portfolio of top 50 businesses. While we think equities are risky, we think the property that we have invested our money is actually safe. Because it's tangible, we feel it's safe. But to me, these 50 companies are far safer than a single property that I may have put money. This is an example I want to give, how in the long term wealth is created. There are a lot of mutual funds in India and across the world where in 25 years, 30 years, your money has grown by 100 times, right? 100 times. I would doubt not many properties would have grown 100 times in last 20, 25, 30 years. This is the power of compounding, which I want to share. And if in 22 years it is 100x, if you wait for 4 more years, this has become 200x, right? So whatever you earned in the first 22 years, you earn in the next four. This is the game of compounding that I want to play. And there are a lot of mutual funds in India and across the world that have this track record. Unfortunately, investors have not made it because we didn't stick. And in 22, and whatever you made in the first 26 years, actually you end up making the last 2 years. Same again, double, right? This is how the richest men and women in the world create wealth. But I told you the returns are non-linear. There have been years where you lost 56%. If you came if you invest at the wrong time. So equities has a very golden rule. It says if you can't handle me at my worst, you don't deserve me at my best. It comes with both upside and downside in the near term. You have to have patience, give minimum 5 to 10 years, and then only you will see the results. There will be years where you will see no result, no returns for 6 years, right? Unfortunately, a lot of people lose patience, and they are actually chasing the most hottest. So I see a lot of people recently invested into gold and silver because that went up, and people think this is going to go forever in the future, right? Worldwide, investment return is always high, but our return is never as high as investment returns because of our own behavior. You remember the first slide? We are our biggest enemy, which is what Benjamin Graham said. We always invest in any asset class only when it has gone up already because the recent performance looks very good and we come at the top, we exit at the bottom. We keep doing this all the time and we wonder that why we have not created wealth, right? And we generally try and copy others. Uh, Wealth can never be created by copying others. You have to have your own research. What I've realized in this long-term wealth creation is that patience is a virtue in investing, but in short supply with most, right? Unfortunately, the whole most of us actually follow the left-hand side imaginary pyramid, where we are all focusing on uh, which investment makes sense, returns, timing, tax efficiency, predictions. We're not really focusing on the real pyramid, which is what are our goals. And in this case, the goal is financial freedom, so that you can have a successful work-life balance, right? So that's my goal. To achieve that goal, what should be my plan? What should be my allocation? In how many years I want to achieve this? And no plan will be good if you don't control your behavior. If you don't execute it well, your project is only on paper. Finally, the investments only play 10% of the role. Where should your money goes is only 10% of the task. Unfortunately, this 10% of the time, this 10% of the thing, we actually end up focusing 100% of our energy into that, right? Warren Buffett is my guru. And in India, we have Ramdev Agrawal, who is like Warren Buffett of India. He came to Mumbai with nothing, ended up creating 1,000 crores, which is a lot of money. And he says, you too can do it, right? I was really inspired by this line that even I can do it. While his journey again has not been linear, he started in 1990 and today we are in 2026. By the way, this 1,000 crores he touched in 2016. And just to let you know, today is worth almost 15,000 crores, 14,000 crores. He's an entrepreneur. He makes a lot of money by working hard, which is his human capital. Plus, whatever money that he has earned, he put it to work, which is financial capital. So both capitals are compounding. And that's why 1,000 crore, what you saw in 2016, in next 10 years, that 1,000 has become 15,000 crores today, right? So this is how you compound money. Inspired by him, I said, I also want to create a lot of wealth. But of course, 1,000 crore is impossible for me. Very few people can be like Warren Buffett or Ramdev Agarwal. There's a movie on YouTube. I would strongly recommend all of you to watch it by the name One Idiot. In this movie, this idiot was worth 100 crores by the age of 50. And the world didn't know that he was worth 100 crores. And that's why they would tease him by the name Idiot. But when they come to know that this idiot has really made a lot of wealth, uh, they felt very embarrassed. And this idiot shares his secret sauce that how he became one idiot. I saw the movie in 2010, got inspired, and I said, I want to become the real one idiot in my lifetime before I turn 50. So that's my challenge that I want to create 100 crores. In India, 100 crores is a lot of money. Very few people would have this kind of wealth. I started my journey at the age of 30. For this 100 crores, I need to invest 4 lakh per month, which is a big amount. Top this up by 10% every year. So next year, it should be 4 lakh 40,000 a month. This is like dollar cost averaging. Every month you're supposed, because we earn every month, we're supposed to invest every year, every month. Do this for 20 years. And at 15%, you hit 100 crores, right? Game plan. Any project, it has to be specific, measurable, achievable, realistic, time bound, right? Now, at this stage, it may not look achievable, but let me tell you, in August 2010, I started my journey with a very modest amount of 10,000. I told myself I need to start somewhere. The only good thing I did, With the income that I kept on earning, I increased my investment per month because I wanted to achieve financial freedom by the age of 50. Right? I said I'll work crazy for next 20 years, work hard so that I can do whatever I want to do today, later on. So today I'm doing almost 41 lakh 20,000 per month investments in SIPs every month. It goes from my bank account. Why I'm doing this? Because before 30th birthday, I was following the first chart. You earn money, you spend, and then you save. Because you have no control on spending, you don't know what to do with the saving. Then I change it to the other approach where I earn. Next day, my SIP goes away 20%, 30%, whatever you can decide. And then I spend. Warren Buffett says, don't save what is left after spending, spend what is left after saving. And today I don't feel guilty. My SIPs are already working, and whatever in my bank account, I enjoy. I don't really, have to worry. I'm playing the long game. First 10 years, nothing will happen. I know for sure. You're just planting the tree. You're just putting the seeds and protecting it from harsh sun rays and stuff like that. But once the tree, achieve its full height and the time, it will give you fruits for rest of life. And I'm not just actually creating the tree, I'm actually making a forest out of it. This is me today. This is me in retirement, right? So this is my own financial freedom plan. Today, my monthly expenses is 2 lakh per month, but in next 15 years, it will become 6 lakhs a month, three times more. Hence, I need 12 crores rupees as my retirement corpus. And to achieve this 12 crore, I need to put 2 lakh 61,000 per month. This is a smart goal, a scientific way to know how much I need in my retirement. If I were to ask you how much you need, most people do not have clue. Most people don't know by when I want to achieve financial freedom. And this is how my retirement life or my financial freedom life looks like. Whether I earn anything beyond 60 or not, this is what I'm going to get passive income from my corpus for the rest of my life. Right? So I tell people think of equity as your third child. Normally, people have two children. Make sure if you have two, actually think you have third child. Or if you have one child, think you have two child. Whatever you're putting for your one child, put the same amount into an equity fund, thinking that's your second child. Do this for 25 years. Trust me, after 25 years, whether our real children look after us or not, this third child will look after us very well for the rest of our lives. Anchal asked me, my mission is to buy a Rolls Royce car inspired from the movie. So I want to buy a Rolls Royce car in next 5 years. Not because I need a car, but because I want to show the world that if I, as a common person, can buy a Rolls Royce through monthly savings and investing in a disciplined way and the power of compounding, then you can buy anything. If you can buy Rolls Royce through SIP, then you can buy anything in the world. Any goal is not too big to worry about thinking. So this is my dream car. In next 4.5 years, I want to buy this. This is a planning that I did for my I have two children. When my daughter was born, Aditi, 24 December 2010, I started investing 10,000 rupees for her. And today she's 15 years, 20 lakh has already become 1 crore, right? This is the power of compounding. And when she turns 25, she'll get almost 3 crore rupees for her higher education. And when she turned 30, almost 7 crore rupees for her marriage. Again, smart goal, right? Plan it well, plan ahead in time. So this is how I've done goal-based investing to make sure that I've achieved all my goals. And the best way is in the initial years, you save and then you start. And once you have got that tree, you start enjoying the fruit for the rest of your life. I'll just skip some of this. Never ask anyone for their opinion, forecast, or recommendation. Just ask them what they have or don't have in the portfolio. So I treat my life very simple. I don't do any complex investments. I believe in the power of simplicity. Almost all my money is in mutual funds in India. I stay on rental flat because in India rental flats makes a lot of sense. I'm not against buying a house, but at this stage of my life, uh, I don't want to miss on compounding. Though I don't compromise on which area I live in the best possible area in Mumbai in the best possible house, right? But next 20, 10, 15 years, I want to really ensure that I don't miss out on compounding. The journey has been a very roller coaster ride. I've been investing my personal money for the last 15 years. The first chart, after 3 years, it was minus 3%, which means it can be volatile. Uh, You don't get linear returns. And then next 8 years in the second chart, 8 years, my returns have been 18%. Then came COVID. Again, it came back to -1%. And again, it went back to 19%. What I want to share is, it's a roller coaster ride. And I'm a very aggressive investor. Most of my money goes in very volatile portfolio. You may not have to have the same thing, but it is a long and painful journey, right? Because you are expecting results better than fixed deposits. Today, I've almost completed 60% of my journey, my 100 crores target. My CAGR has been around 15% for the last 15 years, which is pretty decent. I mean, that was my expectation per annum. So today it's around 60 crore portfolio, and my expectation is around 15%. So in 5 years, you become 120 crores. But because you're doing SIP of 40 lakhs per month, uh, in next 6 years, you get 40 from this, it becomes 160 crores. I wanted to achieve 100 crores, but you actually end up becoming 160. And at 60, 60th birthday actually touches 920 crores. And now I'm reminded of Mr. Ramdev Agrawal's thing that 1000 crores, right? You too can do it. So if you would have asked me 10 years back, can I ever see 1000 crores? I would have laughed at it. But now I can see the reality. So the game that I'm playing, friends, is good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. So I'm playing the game of compounding. Uh, Michael Lipper interviewed lots of rich investors. He said the successful investors in the world are extreme people. They concentrate and they're contrarian. I'm one of them. I would not advise you to also follow the same, because this is very aggressive way of investing. Unfortunately, most people don't create wealth because the blue line is the money that you invest, the green line is the market returns. First 5 6 years, the green line and blue line, there's no difference, and many people don't see meaningful results. They stop the journey, and once in a while, again it came back below the blue line because that was COVID, right? 10 years you didn't make any returns. And if you see today, 2020, this was COVID. That's where my money was there. And today, the gap between the green line and the blue line is the highest. So you need to have a lot of patience, discipline, and then you can create wealth. My Through my SIPs, I kept on buying for the last 10 15 years. I don't try to time the market. This is my game plan. So the mantra that I want to just quickly leave another 2 minutes: start early, friends, invest regularly, stay the course until you have achieved your financial freedom goal. You will get wealthy, and as a result, you will be able to achieve your financial freedom target. This is the mantra that you should be really following. Try to save more than you can spend in the initial years. First 5 10 years, nothing will happen, and then the power of compounding will take J curve. Okay. The best time to plant a tree was 20 years ago. The second best time is now. A lot of you may be wondering, wish we had this kind of session many years back. However, the truth is, across the world, only 1% people can be without debt. Only 1% can invest for long term. Only 1% can delay gratification. Only 1% can develop patience. And hence, only 1% can achieve financial independence. This is the truth. This is a fact of the matter. Friends, if you don't find a way to make money while you sleep, you'll have to work until you die. So you have to make sure that your money works for you so that you achieve financial freedom, so that you have great work-life balance. I would like to stop here because we want to take more questions. But just 1 minute last, Anchal, before I give it to you. To me, Anchal, the highest form of wealth, and we talk about successful work-life balance, is the ability to wake up every morning and say, I can do whatever I want today. That to me is a great work-life balance, right? That to me is financial freedom. And to me, the best use of money is to buy time, right? If I can buy time for self, family, friends, near and dear ones, and of course, if you have more of it, please share with our society. So, so this is where I would like to end. Just a wise man once said, "Don't give your advice, live your advice." People get your message by watching you. So I'm trying to live this advice, whatever I've shared with you today. And finally, I would like to stop here by saying the messenger is a message. You know, I want to become one idiot so that a lot of people can get inspired that if this person can do it. So am I, because I come from a very common middle class family background, worked hard for 20 years, and trying and achieving this kind of wealth to show that it is not impossible. You can also buy a Rolls Royce. You can also live a dream life uh, by following certain ground principles, the first principles rules. So with that, I would like to kind of stop here. Anshul, ready for any questions which our audience might have. Over to you.
Thank you, sir. I think yep, thank you so much. I think we all have got the message from the messenger. Okay, you have shown your authenticity by sharing your real life evidences rather than very theoretical around. You shared that what are the lessons learned from the wise men's theory. You shared that the power of compounding is not theoretical, it's pragmatic, but it requires some 1% thinking. You also emphasize a certain aspects of asset classes, markets. Ultimately, the underlying underscoring was the perseverance and the discipline. And I remind myself, there is, in fact, something in the morning I was listening around while to the work, and of course, I resonated something on it when, since you mentioned in this web broadcast today, here is that income generation versus wealth creation. Okay, that's another aspect of thinking about money. Okay, so are we entangled in income generation side, or also we are thinking about wealth generation perspective, wealth creation perspective? And I think that's where he goes naturally, that I remember that one thing is that you don't need an extraordinary returns, as you said. Okay, we just need ordinary returns from an for an extraordinary duration. And I think that
Absolutely.
is what actually you were telling, right?
Absolutely. I think you put it so well. See, Ramdev Agarwal has been a great stock picker, or Warren Buffett has been a great stock picker, right? We cannot be like them. They are
Hmm.
born once in a century, these people. But you and me, we can all invest through a mutual fund, which is a common vehicle for all of us, which is a
Yeah.
diversified vehicle where 50 companies you put in your money. And if you end up getting 12, 13, 14%, whether you invested in NASDAQ or S&P 500, each of us could have got last 15 years. But if you invest for extraordinary period, 10, 15, 20 years, that's where you see the J curve. The power of compounding goes up. Unfortunately, most of us don't complete this journey. We stop at 5 years or 6 years or 3 years because we're not seeing the results.
Yeah, and that is where I think the 1% theory comes in, right? Because that's what I think the people lose on. But I think I have a lot of questions, especially since you mentioned your facts and figures quite well. Let me pick up some repetitive questions around. If they are overlapping ones, let me just have a look. So, of course, we have one question is around. I don't know whether you answer to that or not. Is about the will. You mentioned about the will. Uh, I don't know whether you have answer to this. Somebody asked here in the chat is Andrew, what is the average cost of a will in UAE? Are there any special tips about it in general as well? So you would like to share anything about that?
Yeah, sure, Anshul. So generally, see, if your family situation is very simple, where it's not very complicated, today ChatGPT or AI tools can create will on the fly, right? Yeah, at least in India, you need to just write it on paper, have two witnesses, and that's as good as a valid will. But of course, it differs from countries to countries in which country you live, so you have to understand. But if you have huge number of assets and your family situation is a bit more complicated, I would strongly recommend use the services of a lawyer or professional because if you do one mistake, you can leave a very messy situation behind. Uh, so that's very
Great. No, valuable, wise advice. Of course, seek professional guidance was one of your tip. In fact, ultimately, so when things go spaghetti way, that's where you
yes.
start finding out where I have to start, and that's very costly mistake. Thank you. I think we have a lot of questions from our ex director, Mr. Funny. I would like to pick up. I think he has got an answer about one idiot thing, what he was quite astonished with. So you explained what is one idiot, and he can watch the YouTube movie as well. Now he has a couple of more since he's been asking very patiently. So, two things. Of course, he's an NRI Indian here, and as an exposed to income tax, hence how much fund is need to be kept in shares, keeping the tax fund low, and also Indian equity markets, how much fund should be kept in shares. Just an idea.
So the good thing for Indians living in UAE is if you invest in the Indian markets in India, you don't have to pay any income tax as of now because there's a double taxation treaty between UAE and India. So you are actually fortunate. We as resident Indians have to pay short-term or long-term capital gains tax when you invest in mutual funds, but you can actually claim complete exemption because you are UAE residents. That's a great thing, because uh, almost 10 to 15% is saved from this. Of course, the only disadvantage as a UAE resident, if you need this money back in Dubai, there is a currency depreciation angle, at least 3 or 4%. So that is something which you have to take care if you need the money back in Dubai after a long time, right? But as of now, today, my 90% of my money is in Indian equities because I feel in next 10, 15 years, this is the market to get. 10% is in China because China is very cheap. I have right now 0% exposure to US markets because, see, I'm a contrarian investor. I invest only into something which is cheap because Warren Buffett said the first rule of making a lot of wealth is buy low, sell high. Anything which is low, you buy. Anything which is high, you sell. That's how you make the difference. So I try and look out for ideas or countries or investment that have not worked in the recent past. So like just to give you, it's not a recommendation or anything. Like gold has gone up pretty fast in the last 1 year, pretty high. Someone like me will be finding it very difficult to invest in gold at this stage, right?
Mm.
Because everything eventually is cycle, right? If things have gone up, they will come down. If things have gone down, I'm sure real estate in Dubai has gone up pretty high in the last 10, 4, 5 years. You would recall a lot of people who have been in 2008 post that Lehman crisis, real estate crashed, right? So everything is a cycle. If you can read cycles well, then I think you can actually make a lot of money.
Okay. Thank you. I think that's a very fundamental advice coming to that. Interesting one. Jose is asking that how does it feel? He talking about an emotion. How does it feel when you pull out the funds from your investments?
So see, in my case, it's a little different situation, Anshul, because look, we have two ways of making wealth or creating, getting income. One is your active income. The second is passive income. Or you can say first is human capital, the second is financial capital, right? In the initial years, we use human capital to build financial capital.
Yeah.
And there will be a point in time in life when we have very little of human capital left and we have a lot of financial capital. So if
Right.
your expenses crosses your active income the day, if your active income stops or your expenses are higher than your active income, you start growing from a passive income.
Mm.
I'm an entrepreneur, Anshul, and I love my work. I don't see myself retiring at 50 or 55 or 60. I'm also lucky in a right profession where I see a long-term trajectory of this profession. So as long as my active income is going to be very high and my expenses are below that, I don't think I need to touch that passive income, except maybe to buy that Rolls Royce car in 5 years. Maybe 15 crores is when I'll need, but I'll be happy taking out money because that was the project that I took, that I want to buy a Rolls Royce at 50th birthday, and I successfully executed that project. So I don't. And finally, what is the purpose of money? The purpose of money is to be spent, right? I don't want to just see only on paper. So that's why I have all these goals planned, and as and when each goal comes, I withdraw money and use that to complete that project.
Okay. Nice. So, coming to asset classes and how to pull out the money, how does it feel? And coming to the insurance, you mentioned something about insurance also. So, question from Amir is that you mentioned about term insurance. You mentioned, right? So, the question is that why don't you have mentioned or you would like to advise about uh, something which is a life universal life cover, where
Yes.
you get tax advantage, you get permanent protection, set of coverage after the set years rather than the long term perspective of planning and needs. So what's your thought around it?
Correct. So, see, my belief is generally world over term life insurance is the best insurance because it's a pure risk life cover. Uh, why do we buy insurance, Anchal? Because why do we buy fire insurance? Because if there is a fire calamity tomorrow at house, we have the insurance coverage, and whatever loss that has happened due to fire, we can get it reimbursed. Same thing is for my to recoup my active income loss, right? So I don't need insurance to build wealth or to leave a legacy. For that, my investments are there, other investments. This is purely what if I don't wake up tomorrow morning? And whatever I could have earned in the next 10 years, at least I have a protection cover which would give my family that wealth so that they can maintain the same lifestyle, right? Uh, in India, universal life insurance is not very popular, and again in US and many other countries. But there are in some other countries where universal life insurance have a tax advantage and also are tax free, or they're not part of that estate. So you need to talk to your financial advisor in that country or whichever place, and then weigh the pros and cons of each product and decide accordingly.
Got it. Got it. And last but not the least, question from Sandeep is there again more of a kind of what kind of percentage allocation would you suggest in each asset class? Anything?
Frank,
Of course, it depends on person to person. It
yes,
depends on
actually.
your goals, smart goals, and but yeah, over to you.
Yeah, you're right. Absolutely right. There's no one size fit all. See, I always say, Anshul, personal finance is more personal than finance, right? Even between a husband and wife, it would differ very meaningfully different. It all depends on what is your risk appetite. There are people who are not happy with 15% return, and there are people who are happy with 8% return also. So horses for courses. But if I were to give you a generic answer, there is a wonderful thumb rule which says your 100 minus your age. So if you are 30 years, you should have 70% in equity. Tomorrow, if you become 60 years, 100 minus 60, only 40% should be in equity, which means as you age, you should have less of equity because equity is supposed to be more volatile. You need more time. So as you age, keep more debt. So that's a thumb rule. But just to give you a contrast, Warren Buffett at 95, entire 100% of his money is in equities.
That's why he's Warren Buffett.
And guess what? And guess what? At 95, he still talks about long term. you know?
Okay, perfect. I think we are overshooting a bit time here. So, but I would like to take one last question still. How about ETF investment long term in US market? Because I know a lot of people would be quite eager about it. How would you suggest about asset allocation for a fixed deposit equity for a 32-year-old profession for retirement in percentage? Again, a very specific question about age and person and location. But what about ETF investment in US? What do you think about?
Okay, a beautiful question, wonderful this thing. So just to give you a very easy answer, imagining it is do it yourself, you're not taking any advice.
Yeah, yeah.
If I were you, I would put one third in all three right now through ETF for the US market, let's say, one third
Hmm.
in gold and one third in bonds. Now, what will I do every year on 1st of January? I would rebalance. If something has gone up too fast, too soon, whatever
Hmm.
profits I've made, I'll withdraw from there and invest in that asset class which has not gone up. So it's basically like rebalancing every year, right? And if you can do this on your own, then actually you don't need advice. You don't need an advisor, but you have to have that discipline, to do it, right? And I'm
Okay.
sure you will be able to achieve your financial that project of your financial goal in next 10, 15, 20 years.
Inshallah, I think that's what everybody is eyeing for, and that was the whole purpose of attending today. But I think thank you so much, Gajendra. I think that was a really wonderful and insightful, authentic session. We have gone through understanding something which is beyond technicalities of the project management at times, but again, since discipline comes, since scheduling comes, since cost comes, definitely it is one of the important aspect of project management what you just taught us today. So again, a heartfelt thank to you for managing your time and then giving us these insights. I would like to thank rest of the audience who have been asking the wonderful questions and being staying with us in the large numbers to making this particular possible. That how this interesting webinars can become much more interesting. And we've started our surveys after the webinar. You're going to get a pop up to respond to your questions and then use this opportunity to give us more insightful ideas, ratings, feedback, and so on and so forth. With a special recognition to the team in membership, outreach, volunteering, finance, and marketing, who've been doing the perfectly great job to making sure that whatever we are doing, you're reaching to the right global community in the form of knowledge, in the form of awareness. And remember, leadership isn't about creating, executing the task. It's about inspiring people, just like what our speaker did today, navigating complexity and leaving the legacy with an impact there. So I think that's where the true measure of project professional comes out rather than number of projects delivered. Basically, what kind of difference we do as a part of community there. So with me, Joyce and Amir, I think thank you, Gajendra, and the rest of the PMI team for rest of the audience. This is Anchal Chauve wishing you a continued success and inspiration in your projects. Thank you so much. Have a lovely night ahead. God bless.